Welcome back to another Antipodes Insights video, where today our focus will be on the Antipodes Asia Fund. I'm joined by John Stavliotis, Portfolio Manager for the strategy. Welcome, John.
Thanks, Jonathan.
Again, in 2025, we've seen strong performance in the strategy. John, can you sort of give us a recap of what happened?
Yeah, sure. So the Asia Fund was up 20% for the year, which, Asia outperformed global indices and Australian indices. But one of the interesting things which we saw in Asia, China, and EM more broadly was concentration of returns. It was circa 30% of stocks in the index beat the index, which is the most concentrated return series in the last 25 years.
Wow.
Which is pretty interesting. Look, I put that down to it's the first year of Asia outperformance in some time, and it's really probably global investors coming in and buying the large caps and buying the thematics. And it's evident if you break down in the returns, the tech hardware sector accounted for 61% of the return of the benchmark. So it's concentration at the sector level as well. And if you look at countries as well, there was a similar sort of thematic that was going on. Look, with our value process, that made it quite difficult to keep up, and we underperformed the benchmark, given that the tech hardware sector and some of the high valuation stocks were leaders in the benchmark. But we've started to see that turn in the last 6 months, and we've generated alpha in the last 6 months where returns have started to broaden. If you look at our positioning, we've got a weighting towards some of the structural winners where we see value, and also some of the cyclical stocks that are showing deep value, but importantly are showing quite resilient earnings performance and will benefit from any continued recovery in the economies that we're expecting going forward. So in that way, if we do see a broadening of returns in Asia and an improvement in the underlying economies, we think that the portfolio will perform quite well.
If we look back at history, we have seen, a prolonged period of emerging markets broadly underperforming developed markets. And this has obviously disappointed investors, even though they've seen attractive valuations. Now, we've seen great returns in the last couple of years relative to developed market equities. Is this an opportunity for, investors to participate, or have they missed the boat? How do you see that in light of especially our process?
Yeah, look, we think there's a number of indicators that are pointing to a turn into a longer period of outperformance for EM Asia. Really, some of the indicators we look at are, for example, US dollar weakness. So US dollar has significantly outperformed other currencies over the last 15 years, and there are signs of that topping out now. We're also seeing interest rate normalization in the US, and importantly, global growth is recovering relative to the US. So what's driven that developed market outperformance is really coming down to US exceptionalism. If we do see global growth catching up with the US, and we're seeing that through improvements in commodity prices, strong fiscal positions in emerging market economies, if that growth continues to recover, we will see emerging market Asia, for example, outperform. And another interesting number to sort of that I like to quote is the market cap of the Magnificent Seven is over 2 times the market cap of the MSCI Emerging Markets Index.
Amazing stat.
Yeah. And what's interesting is if you do get that growth normalizing, you'll have a huge a small amount of money coming out of those top companies will have a huge effect on the equities in emerging markets in Asia. And that's what will drive a sort of longer period of outperformance.
Ex-China, we also have participated in a number of other countries where we think that's undervalued. Now, it hasn't necessarily paid off in the short term for us. One of that is, Indonesia. We have a structural overweight there. Can you talk us through what's happening in Indonesia, macro level, and how do we participate at stock level?
So look, Indonesia was the worst performing market in Asia last year. And the overweight here would be quite controversial relative to other investors globally. It is very underowned at this point. To explain why we've, to clarify, we've gone overweight in the second half of last year, taking advantage of that underperformance. To sort of explain how we get to this overweight, we'll talk through what's happened in the last year. So you had a change in leadership. Prabowo government came in. They've changed the rhetoric in Indonesia quite a bit with what was previously focused on investment is now a little bit more focused on consumption and trying to drive GDP growth through consumption and elevating that middle of the economy, which has been suffering for a number of years. That led to, I guess, a lack of confidence in the economy, and also pullback spending by government bodies and government companies, related companies, in that initial stage of the new government, and we could see that in the data. We also had MSCI threaten to lower the weightings towards Indonesia, which has scared off a lot of global investors. We've done a lot of work. I won't go into the details here, but we've done a lot of work to analyse what needs to be done, and we're seeing that the government and the regulators in Indonesia are meeting the demands of MSCI, which will take away a liquidity threat. And valuations in Indonesia are at lows we have not seen since GFC or Asian crisis.
Okay.
The average index valuation is at a 25th percentile of where the index has traded historically, which really brings an opportunity to buy some resilient growth businesses that are actually performing quite well through this period. Now, fast forward to when we've started to go overweight, the government has started to set their policies in recent months and actually enact some consumer stimulus. We've started to actually see consumer sentiment figures start to improve since September last year.
Okay.
And they've continued to improve all the way into January. We're starting to hear commentary from some consumer companies improve. All of these things are pointing to that disruption of changing leadership having found a bottom. And we're also seeing from, we talked about what will drive EM equities, a lower US dollar, lower rates will really help one of the issues of liquidity in Indonesia. It'll increase liquidity in the system, which will help drive investment, drive consumption, and drive equities.
Another focus within Indonesia has been the banking sector. It's again driven by valuations, but there's some structural themes within that, and our exposures through Bank Mandiri. John, can you walk us through that?
Yeah, so the Indonesian banking industry is quite attractive. A bit like Australia, it's controlled by 4 banks. So the top 4 banks have got circa 50-55% share of loans. Mandiri has about 14-15% share. So it's one of the key banks in the industry. The issue with the banks and why they've traded so cheap, and I alluded to this just earlier, is you've had a lack of liquidity in the system and a lack of growth in deposits. Now, what that's meant is that you've seen net interest costs go up for the banks, and it's meant that they haven't been able to grow deposits to drive loan growth. So loan growth has slowed. Now, there are signs of this, as I mentioned, starting to improve. We've started to see deposit growth pick up in the last quarter, and with a weaker dollar, lower rates, that helps keep liquidity in Indonesia and will help drive growth in the industry. We've also seen the regulator try to stimulate the banks into driving more lending, which is quite positive for this business. Now, Mandiri is a very high quality bank. It's got a return on equity of 18%. It's now trading at a price to book of 1.5 times, which is well below its historical average multiple. And when you think of through cycle growth for the Indonesian banking system, or for Mandiri specifically, we think it's in the low to mid-teens, which is a high level of growth, right? Especially when you're thinking about Australian banks and where they're trading relative to ROE and growth, Mandiri really stands out. So we see this as a really attractive opportunity to increase the size of our position. And although growth is slower right now, we are getting paid for that. The dividend yield on this stock is currently over 8%.
Wow.
So that we're getting paid to wait until we get back to through cycle growth at a very attractive valuation.
So overall, as you can see, Asia provides a very diverse set of opportunities. The performance has been strong in the last year, especially compared to developed market equities as well as Australia. The stories right across the region are very differentiated, not only in China, but also a very much unloved market, which is Indonesia, which we've taken that opportunity to sort of get into. And that's why how our pragmatic value philosophy really comes to life. Now, if you have any further questions, please reach out to your Antipodes representative or your representative from Pinnacle Investment Management.